is that 2/3 of the return, your average return is like the long-term average return. 2/3 of your returns are then between, 14% with that, so that's plus 26%, or negative 2%. So around about 2/3 of the returns are in that area. So in a year where we've had returns more like negative 15, it's quite an unusual event down this way. And that's consistent with what we see. We haven't really seen a negative year since the early part of this decade. So it's not a common event, but it's still well within the bounds of what can happen. Cash, though, for example, if we were to do a graph of like cash-like returns, over the long run it might have a return more like 9%, but a much smaller spread of returns. The standard deviation, the volatility, the spread of returns is much less, because cash only moves with whatever the cash rate does. We're never going to have a return from cash of negative 14%. Thank goodness, because that's an important part of building portfolios. So it's a much smaller spread of returns. What we're trying to do at a portfolio level, in a theoretical context, and we have to be careful to say a lot of this is a theoretical context, we'd love to get as much return as possible while increasing that volatility. Let's face it, if there was an asset that produced 12% a year with no volatility of returns, we'd all just invest in that and we'd be down on the beach rather than sitting here listening to myself. But that asset doesn't seem to exist. Occasionally people promise it. It was not dissimilar to what Westpoint or FinCorp were promising, but we saw that there were risks hidden behind that. So they're the two key concepts. Correlation, how assets relate to each other, and standard deviation, the spread of returns of like an investment, a portfolio, or an asset class. If anyone's not comfortable with those, just sing out, or we'll move on. I'll just make the general advice warning that what we're talking about today is general in nature. It hasn't taken into account your personal circumstances, and you should check prior to taking action, which is what was said as well. So, just looking at one of my key biases is that there's a lot of investment information of a very high quality that's available from academic research. Research that has looked at how portfolios have worked, how assets have worked for a long time. There's a Nobel Prize in economics that's often awarded to and has been awarded to for the thoughts that go around building a portfolio. People like Markowitz and Sharp, high quality information. And one key area of asset allocation is that it really matters in building portfolios. This report from Brinson, Hood and Biebauer found that it explained well over 90% of the difference in portfolio returns over time. So the sample was a bunch of US pension portfolios, and it looked at how they varied and what made the difference. And the difference was what asset class they were exposed to. We can think about that in the context of the year that's just gone. If you had a portfolio that had 20% shares and 80% cash, that's going to be a really crucial influence on how the overall performance was compared to someone who had 80% shares and 20% cash. And even more so if those shares were resource shares that did quite well, as opposed to bank shares that didn't do so well and still aren't. So, the authors of this paper, which was published in Financial Analyst Journal, said total return to a planned investment portfolio is dominated by the asset allocation decision. Another paper came with a similar conclusion. Ibbotson, a very well-regarded researcher, and Kaplan, says that the choice of asset allocation explains about 100% of the returns that any fund received. The most important thing was which sectors, which asset classes money was allocated to. And I want to make a clear comment about this here. And this is a very stylised and over-exaggerated example to try and make this point. We've got two portfolios here. One has $100,000 invested in at the start. The other has $100,000 invested at the start. One has quite a volatile return. 0% one year, 10% the next, 0, 10, 0, 10. The other gets a constant return of 5% a year. So in both cases, the average return is 5% a year. But you can see that the compounding effect, the interest on interest on interest effect, means that the portfolio that had the return, the more steady return of 5% a year, actually had a higher ending balance. And this is something that's often missed, in that we often talk about volatility, and it's assumed that we as investors prefer to have, if we were going to get a choice between, do you want 5% a year steady or 0, 1, 10, 0, 10, we'd prefer the 5% a year just because we prefer less volatility. We don't like to log into our account and see it's fallen. But in reality, there's also a compounding effect. If we can keep the volatility of a portfolio lower, we're going to be a little wealthier in the long run, and that's not a bad thing. As we discussed in terms of the key concepts, standard deviation is what measures the spread of investment returns. So we talk about Australian shares having something like 14, 15% return, cash and 2% return. And now we come to thinking more practically about things. And I think this is a very interesting time to actually be doing this, because for so long the recipe has been pretty simple for us as investors. It's been to load up on Australian shares and just enjoy what has been a very strong ride. Overseas shares have been terrible. I don't know if you remember, but 1999 there was an event they referred to as Dow 10,000. And that was when the US stock exchange went through 10,000 points. Shortly after, same year, Dow went through 11,000. And this year it went through 11,000 twice, once down and once up. The long-term returns from US asset classes have been really poor over that time. FTSE went through 6,000 points in 1999, and it's below that level now. So the interesting challenge has been that Australian shares have been tremendous. We can forget about international shares for quite a while. As a financial planner, I often see portfolios that were put together around 99, 2000, where international shares had actually outperformed Australian shares, so there were more clients were in global shares than Australian shares. But that really has reversed now. But the challenge is, this is looking backwards, what's the result looking forward? And I would say one key thing about this asset allocation decision is that there's a lot of research now in the Australian environment that says the extra benefit that we get in Australian shares, which is franking credits, are actually unpriced by the market. So that means you get returns three ways from investing in shares. One is you hope the value of your portfolio will go up over the long term by about, say, 7% a year. I think it might be a little bit less going forward. You hope that you get income of 4 to 5% a year as well. But you also get franking credits of about an extra 1.5% a year. And that's not priced in to shares. So by that I mean, that's an extra bonus that you get that doesn't change the overall return. And the research from that has come from the University of Queensland. So Gray was one of the academics there. Done quite a lot of looking at how this works and whether it is in fact a free lunch. So there is always, when looking at different asset classes, we've got to keep in the back of the mind that this is an extra bonus for investors. Correlation, again, just going back over that. The way, in this case we're talking about, the way assets move together. Do they move in a perfectly correlated way, exactly the same way with a correlation of 1? Is it random, correlation 0? Is it -1, correlation of 1? Unfortunately, that's only in theory. So now I want to, again, moving more towards the practical side of things. This is the long-term return from asset classes, as long as I could reasonably find. And you'll see in the title that I've put where each data series starts to, but they're up to the 30th of June 1970. So Australian shares from 1st June 1970 through to now, 13%